Joining us now, Eric Freedman, U.S. Bank Chief Investment Officer. What a year so far, Eric. Did you start with a bullish outlook for 2025? What type of year-end numbers were you talking about for the S&P when we started?
So we had a 63.25 figure
at the beginning of the year,
which was tested. It's been tested a couple times. So we stuck with it. We think we're probably...
You have?
We have.
The whole time?
The whole time. The whole time. We'll probably use this opportunity, because we're actually ahead of our price target right now, to basically evaluate the second quarter earnings season. And again, we think that with the clarity on tariffs, with some clarity on business optimism, we think we're going to probably revise higher. So net, we think that this is still a glass half full environment, and we've been sticking to those targets.
You could go out a hero just staying where you are and not having panic during Liberation Day.
There was an opportunity to flinch, and it's certainly the dark days of April 7th, 8th, and 9th. We felt every tick. But, the reality, I think, Joe, is that what we try to do is just look at the data in and of itself. If you look at some of the consumer activity, without question, your guest prior, we're on the same page. We think the consumers are probably more in an opportunity to grow wallet share as opposed to really hunker down. We think that especially the lower income and the higher lower income consumers are actually in a pretty good spot here. So they've endured a lot of cumulative cost, but we do think that there is some upside, especially as businesses, we think come back to hiring a little bit more.
You probably think that there are certain net negatives. Are tariffs net negatives? I mean, there are people that think they're net positives for the deficit or for other things, but let's say you do think they're net negatives. Why has the market been so resilient? Why do you still see further gains? Is it because the tariffs aren't as bad as we thought, or are there other things when you look in total and you think of net expensing, or you think of deregulation, or, take your pick of the other, energy prices being lower? Any of the tailwinds, do those just counteract the tariffs? Or
I think, Joe, it's one of those things, kind of borrowing from your bio background. We think that this whole concept of homeostasis, that the economy adjusts, it adapts. And if anything, when you have a company like Home Depot saying, look, we're not going to pass through all of our tariff expense to a consumer, there are the opportunities for absorption. I think that number one is that most of the tariff cost we think will rest more on goods than on services, which is still, an incremental positive for the economy. Without question, we think there's a cost that has to be paid. So I think that absorption process, that adjustment process continues. And again, companies and consumers are taking things in stride. I think that some of the data we look at, high frequency things like restaurant bookings, attendance at sporting events, attendance at movie theaters, those are still pointing not just to normal levels, but actually expansionary levels. So we do think that, the cost structure of the economy has probably gone up, but we also think that the economy does adjust over time.
What about productivity and AI and things like that? Does it factor into? Is that a long-term thing, or is it real?
Yeah, it's real. I think if you look at right now, AI hasn't really been fully diffused across sectors. It's been very, nonlinear. If you think about the industries that have been impacted, things like manufacturing, things like retail certainly have been impacted. Financial services, where I work, hasn't really been as impacted as much. Healthcare certainly has an opportunity for some further productivity enhancements because of AI. So I think that the challenge, though, will be how the labor market adjusts. That is a slow-moving mechanism. So I think, if anything, there's been this very gradual diffusion of AI technology. We think that probably out 2-3 years, that's when the labor market will be especially tested.
Do you think that the hollowed-out core of this country that sort of spawned all these moves, does it work? And when do you act? I mean, there are a lot of investment is coming in. The president's managed to get a lot of, maybe some of it was already coming, but on the margin, there's more coming in. There's going to be more manufacturing. We are seeing some, domestic companies bringing stuff back or retrofitting factories. How long does that take? Would that be, will the next administration get to take credit for that, or will it be near term?
Yeah, I think you're seeing some incremental growth. I mean, you think about where you grew up, Joe, in Ohio, where I grew up in central New York. I mean, these are areas that had a significant shock in the late 70s and 80s. You're seeing things like AMD put up a factory in Clay, New York. You're seeing an expansion in other spots. So I think that it's less of a necessarily administrative driven phenomenon. I think that there's certainly some things that this administration has done to create it. But I also think the priorities that we saw during COVID, where we need to have more domestic manufacturing on a prioritized basis, is ultimately a good thing. So that's, I think, is probably a next 3, 5, 10-year type of phenomenon as opposed to a short ephemeral one.